Let's tackle a question that, honestly, is a little scary for anyone with a bank account. What actually happens if your bank fails? In this explainer, we're going to break it all down step by step.
Okay, just imagine this for a second. It's Friday night. You go to check your balance, but the app just won't load. A few minutes later, you see a news alert. Your bank, the place with your savings, your direct deposit, all of it, has been shut down. That sudden, cold feeling in your stomach, it's real. So what happens to your money? And look, this is not just some what-if scenario. In the spring of 2023, this exact thing happened to the customers of three pretty big U.S. banks. We're talking about Silicon Valley Bank, Signature Bank, and First Republic. These were real places holding billions of dollars that were operating one day and just closed the next. So knowing the playbook isn't just interesting, it's pretty darn important.
To get rid of that fear, we have to understand the plan. And believe it or not, there is a very specific, very well-rehearsed plan for when a bank fails. It's all designed to happen fast, stay under control, and most importantly, prevent a total panic. So let's walk through it.
Okay, the first thing you have to notice here is the timing. It almost always kicks off on a Friday afternoon, right after closing time, and that's completely on purpose. It gives the regulators and the FDIC, the Federal Deposit Insurance Corporation, the whole weekend to work their magic behind the scenes. The second that bank is officially closed, the FDIC is handed the keys. Their first job? Scramble to find a healthy bank to buy the failed one. By Sunday night, they're putting out a press release with the plan, because the goal is always the same. When you wake up on Monday morning, it's business as usual.
Now, you're going to hear this word receiver a lot. Just think of the FDIC as the bank's temporary new boss. But here's the key. Their job isn't to save the bank's shareholders or the executives who ran it. Nope. Their one and only mission is to protect you, the depositor. They do that by managing what's left of the bank and making sure you get your money back.
So, the best-case scenario, and the most common one, is called a purchase and assumption. This is where a healthy, stable bank, think JP Chase in a couple of recent examples, steps in over the weekend and just buys the whole operation. For you, the customer, it's almost like nothing happened. On Friday, you banked with Bank A. On Monday, you bank with Bank B. Your debit card works, your online login works, everything is designed to be totally seamless.
But what if nobody wants to buy the bank over the weekend? Well, the FDIC has a plan B for that too. It's called a bridge bank, and it's exactly what it sounds like, a temporary bridge to get from the failure to a final solution. The FDIC literally creates a brand new government-backed bank and moves all the insured money over. This makes sure that you can still get your cash and pay your bills on Monday morning while they keep looking for a permanent buyer.
All right, we've seen the process. Now let's get to the question that you really care about. What about your money? What are the actual shields that are supposed to keep it safe?
This right here is the bedrock of the entire U.S. banking system, FDIC insurance. It was created way back during the Great Depression, for one reason, to stop bank runs. And you know what? Its track record is perfect. Let me say that again. Since 1933, not a single person has lost one penny of their insured money. It's a rock-solid promise from the government that your savings are safe up to a limit.
And that limit is $250,000. But here's the really crucial part. It's $250,000 per depositor, per insured bank for each account ownership category. So what does that mean? It means if you have a personal account, a joint account with your spouse, and maybe an IRA, all at the same bank, you're actually insured for much more than just the base $250,000.
So what does this actually look like for you on that Monday morning? Well, for most people, pretty much everything works just fine. Your paycheck will still get direct deposited, your debit card will work at the coffee shop, your mortgage payment will still go out. The only potential issue is for money you have above that insured limit. That portion might be frozen for a bit while the FDIC figures things out.
If you do have uninsured money, you get something called a receivership certificate. Basically, it's an IOU from the FDIC. It's your official place in line to get paid back from whatever assets the bank has left. As the FDIC sells off the bank's loans and other investments, you get paid back in chunks called dividends. Now, it can take a while, but historically, people often get a very high percentage of their uninsured money back.
But there's also a big red emergency button. If regulators decide that a bank failing could start a domino effect and crash the whole economy, they can declare a systemic risk exception. Think of it like pulling the fire alarm for the entire financial system. This is exactly what happened in 2023 with SVB and Signature Bank. The government stepped in and guaranteed all deposits, even the uninsured ones, just to stop the panic from spreading. It's a huge move, and they don't use it lightly.
Okay, so that's all the theory.
But how has this actually played out in some of the biggest bank failures we've ever seen? This is where the rubber really meets the road.
This table really tells the story. You look at Washington Mutual back in 2008, brought down by the housing crisis, boom, sold to Chase over a weekend. Then fast forward to 2023. SVB gets hit by a crazy fast digital bank run and the government has to step in. Signature and First Republic got caught in the panic that followed. But look at that last column. Do you see the pattern? In every single one of these huge, scary failures, all depositors, in the end, were made whole.
And this, right here, is the most critical takeaway of this whole thing. The system is built to protect you, the person with money in the bank. It is not built to protect the people who invested in the bank stock or the executives who made bad decisions. In every one of those cases, the shareholders got wiped out. The firewall is designed to be between them and you.
So, the big question on everyone's mind is, after all the chaos of 2023, could this happen again? Let's do a quick reality check on the risks we're facing today.
The short answer is yes. Banks can and will still fail sometimes. But the reasons today are a little different. First, there's interest rate risk, the exact thing that got SVB. They were stuck with old bonds that lost a ton of value when rates shot up. Second, there's having all your eggs in one basket. SVB's customers were almost all in the tech world, a group that talks to each other constantly. And that leads to the third, most modern risk, the digital bank run. Thanks to Twitter and banking apps, customers tried to pull $42 billion from SVB in a single day.
But here's the good news. For every one of those risks, there's a powerful protection in place. FDIC insurance is obviously the main one. But the Federal Reserve also has emergency lending programs to give banks cash when they need it. And on top of all that, regulators are constantly watching over these banks, running stress tests to find these problems before they explode.
So, let's separate the real risk from the fear. Could a specific regional bank that took on too much risk fail? Yeah, absolutely. But is the entire U.S. banking system going to collapse like it's 1929? That is extremely unlikely. The whole point of the modern system is to act like a containment field, to find a problem bank and isolate it so the sickness doesn't spread.
And that brings us to our final point. The system isn't designed for a zero-failure world. That's not realistic. It's designed to make sure that when a bank fails, depositors are protected. It accepts that some businesses will fail, but it builds a safety net for the public. What we've learned, especially recently, is that the real danger isn't always the bank's balance sheet. It's panic. A bank run can become a self-fulfilling prophecy.
So I'll leave you with this to think about. Now that you know the playbook, now that you know about the safety nets, would you react differently if you heard your bank was in trouble? And it brings up an even bigger question people are debating right now. To stop the panic for good, should we just insure all deposits, no matter the amount?
We built this entire explainer on the work from these great sources. You can always dig into them if you want to learn more. Thanks for watching.